Greetings, everyone. Welcome to ARK Studio. So this is In the Know. We're recording this week's In the Know in two phases. The first is on Thursday, so the day before Employment Friday. And then the second will be tomorrow. We're also going to continue in a new format. The first is the first part of In the Know is going to be something having to do with innovation specifically and anything that's happened in the last week that we think is very important. And the second will be, as usual, fiscal policy, monetary policy, economic indicators, market indicators, and maybe a little bit more about innovation. So thank you for joining us. I'd like to introduce my colleague, David Puell, right now. David is very well known in the Bitcoin community for his on-chain analytics. He actually is the author of some of the analytics that many people use. David and I were at Bitcoin Park and at the Bitcoin conference in Nashville last week. It was Thursday, Friday, Saturday. And a lot of interesting news came out. You may know some of it, but I wanted to bring David onto In the Know to give us a sense of some of the exciting developments in Nashville last week. So, David?
Yeah, had a lot of fun with you and other members of the team last week in the conference. I think the first thing that was very impressive to me, and I think to you as well, was
Yes.
Bitcoin Park.
Yes.
Right? We're seeing Bitcoin Park as a sort of central national hub for Bitcoin at the moment, where a lot of Bitcoin devs, Bitcoin founders, and hopefully, Bitcoin policymakers or policymakers in the national sphere who are well aligned with the Bitcoin ethos are, walking into the park, having discussions, interacting with each other.
Yes, and Bitcoin Park was started by Rod Rudy and Matt Odell,
Correct.
I believe, partners. And what I find interesting is, and important, is anyone who goes into Bitcoin Park when there's a gathering is going to meet people who are making the Bitcoin movement happen and know so much about it. So my confidence level in what's going on out there always increases. What I found very interesting about this time, both at Bitcoin Park and at the Bitcoin conference, was unlike several years ago. We're seeing people of all ages, and I found that reassuring as well.
Yeah. Also, this is very atypical. You can see a situation where we have 50, 60-year-old policymaker having direct access to a 20, 30-year-old Bitcoin dev and actually discussing monetary policy or whatever technical aspect they want to discuss on Bitcoin. That was extremely hopeful and impressive for the space.
Yes, and policymakers are gravitating to Bitcoin Park because, that is where they're finding the truth about Bitcoin as opposed to all of the...
It's a very low noise zone area.
Yes. So I guess one of the highlights for me was a conversation with Art Laffer, and he was in his element. I think Art Laffer, for those who don't know, is a very well-known economist. He's known for his tax policy framework, but he is a monetary scholar as well. And so he regaled those in the Bitcoin community with his thoughts about Bitcoin as a monetary system, a rules-based monetary system that he's been waiting for since the U.S. closed the gold window in 1971. He thought that was a terrible mistake. It left monetary policy unhinged. and he's looking at Bitcoin as the solution to that problem. And his knowledge of Bitcoin now is impressive. He's taking this very seriously. And while he's wondering if we'll always have a quantity rule of money in the Bitcoin world, meaning 21 million units max, with a decreasing inflation rate until we hit that point, he thinks ultimately, whether it's a quantity rule or a price rule where you keep the price stable, that when Bitcoin is prolific throughout the global economy, that it will reach an equilibrium point that will look and feel more like a price rule. Now, that's up for a lot of debate out there, certainly in the developer community, where 21 million and lower inflation rates over time are so important. So I guess on to the next one. At the conference itself, we heard former President Trump basically give us a sense of where he would like his administration, should he be reelected, to take Bitcoin from here. So maybe you want to talk a little bit about that, David.
Trump gave a very hopeful speech for the Bitcoin ecosystem to, applause and cheer from the Bitcoin community. Gave you a shout out during the start of which was very, very, very fun to see.
Well, it was also really interesting. He said that he would fire SEC Chairman Gary Gensler if he were reelected. That would be on day one. And the conference went wild, and to the point where he was surprised, and he said, "Oh, okay, I really have to do that. This is really important to this community." I'm going to say it again. So yes.
Yeah, he wasn't expecting that from the looks of it.
No.
Also, he seems to be thinking a lot about Bitcoin mining and positioning that as, at the very least, taking that from a deregulated stance and allowing mining come to America organically, and that has implications in national security and infrastructure, energy as well. The framing of the whole speech seems to be not only getting the Bitcoin vote, but also setting up Bitcoin as part of the competitive advantage Trump envisions, meaning America versus potential adversaries in geopolitical landscape like Russia, China, etc.
Yes, and he gave us a glimpse, as did Senator Lummis from Wyoming, a glimpse at what the Bitcoin part of their platform might look like. Maybe you want to say a few words about that.
So the bill was announced little after President Trump's speech, and it's very sophisticated. Senator Lummis seemed to have, their staffers were very impressive, and they seem to know about Bitcoin and highly, that channel of communication between Lummis's team and the rest of the Bitcoin community seems to be a very well-oiled machine. Within that framework, the bill proposes adding the confiscated Bitcoin, which is over 200,000 as of the recording of this conversation, adding that to the national reserves, and then in addition, buying up to 1 million Bitcoin in a period of 5 years, which was even more surprising. The only perhaps backlash I've heard from some members of the Bitcoin community, specifically Jemison Lob, was that potentially some of that seized Bitcoin may belong to the Bitfinex creditors, meaning because some of that balance comes out of Silk Road, but in addition, the Bitcoin hack in 2016. But apart from that, I think the bill was very well received by the Bitcoin community. It seems to frame the balance sheet of the United States as a standalone. It goes into revaluing a lot of the assets contained in that in the balance sheet, like gold and real estate. I think Senator Loomis mentioned how gold is completely undervalued in our current balance sheet.
Yeah, it's on the books at, I think, between $30 and $35.
Correct.
And of course, it's over $2,400, so highly undervalued, as is land.
Yep.
And the U.S. apparently owns 23% of all. I mean, the government owns 23% of all the land, and Senator Lummis said in Wyoming the government owns 50% of the land. Again, highly undervalued. And the reason we're even talking about this is one of the only reasons that in at least this bill the government would touch the Bitcoin is if it wanted to pay down some of our debt. And that's why the balance sheet came up.
And it's a 20-year hold, and it's fork neutral, which is very important, meaning similar to what happened in 2017 with Bitcoin Cash, there was a major hard fork, which is different from a soft fork, under which the network pretty much splits in two and produces two tokens that you as a Bitcoin holder own by default.
Yes, back then it was Bitcoin and Bitcoin Cash.
Correct. Right. That's the most popular example of that instance. In case something like that ever happens, the bill contemplates to be fork neutral, meaning they wouldn't sell any
they wouldn't take a position.
Exactly.
They would not force one fork over the other. Now, we learned that from Senator Lummis's staffers, and that gives you a sense of how sophisticated, how much they have thought about this, how well they understand it, how much they have studied the past to inform this legislation. So, again, big increase in my confidence that we have some really great lawmakers focused on one of the most important innovation movements in history, one of the most important monetary system movements or evolutions in history. And as Art says, this Bitcoin effectively is private money competing against public money. And so, it will keep policymakers over time focused on preserving purchasing power, much more than if there were no competition out there, right?
Yeah, very interesting. Also, we had RFK Jr. Give an even more aggressive position in his presidential plans, which is buy up to 4 million Bitcoin, so 4x what Senator Lummis proposed. The rate of that would be 550 Bitcoin bought per day, I believe, which is very, very aggressive. Like that's more than the natural selling pressure, a little more than the natural selling pressure coming from miners today. So very interesting.
Yeah, and I guess we would be remiss if we didn't wrap up and include everyone. So we know that Vice President Harris is, unlike at least the reputation of this administration, specifically as it relates to Gensler, she's actually seems very open-minded. I believe she did not accept an invitation to go to the conference because she obviously is handling a big shift in the strategy over there. But I think what has happened here is in FIT 21, so there's legislation that has been going through Congress. It's Financial Innovation Technology of the 21st Century Act, so FIT 21. The big surprise, I think, to this administration and many of us actually, is that either 76 or 78 Democrats voted for it in the House, which was the first significant sign that we have gotten that this is becoming a truly bipartisan issue. And innovation is bipartisan. Who does not like innovation? And so that was a very hopeful sign.
Yeah, people forget that there's a lot of Democrats that like crypto in general,
yes.
Bitcoin, Ethereum, and own it. Mm-hmm. In fact, if we just saw the Nakamoto project survey of about over 3,000 people on a national overview, they concluded that for the most part, Bitcoin owners are young and male, but they're politically neutral in some sense. The main correlative factor for Bitcoin ownership is knowing about Bitcoin and being educated about Bitcoin, as opposed to being Republican, Democrat, centric, whatever. So.
Yes. So, yes, innovation is bipartisan. And so I will be following this part of In the Know with the usual Employment Friday observation. So thank you, David. It's been such a pleasure.
Likewise.
Okay, now on to the next part of the program. And as I mentioned at the beginning, we're going to be doing In the Know in two sections from now on. One will feature other members of the team and their newest research or what they're thinking about news breaking. And then we'll go into the drill. But before the drill, even now, the markets are moving very, very rapidly, as I'm sure you've noticed. The stock market's correcting quite significantly. The correction we've seen in the last week. Bond yields are falling fairly dramatically. Commodity prices are falling and in some cases breaking down. Yield spread, so the spread between high yield bond rates and treasury bonds, that spread is starting to gap out. So the fear is seeping into the markets in many ways and in many indicators. And we do have a point of view, and so I'd like to introduce it. You've heard it here before if you've been listening, but for those who haven't, I'm going to say this is slowly, then all at once. So we have been talking about the rolling recession that has been in place actually since the Fed started raising rates in 22. As soon as the Fed started raising rates, housing effectively went into a recession. Commercial real estate office was already in a recession. Now, multifamily real estate seems to be an issue now. We've seen autos stall out. They've kind of stabilized but stalled out at subpar, meaning subnormal expansion rates. We're seeing capital spending come down. We're seeing consumer confidence relapse. Housing was starting to pick up its head and has relapsed again, certainly if you're looking at sales. So we've had a rolling recession, and now we seem to be in the all-at-once phase. Many people are beginning to understand, we think, that perhaps the idea that inflation is the problem has been misplaced. And this rolling recession is going to end with pricing coming down. So I've been saying the risk is deflation, prices coming down, and listening to Amazon's report last night, it's clear the consumer wants lower prices and is getting lower prices. The consumer is not falling apart yet. It's actually responding to some of the lower prices, even in autos. But nonetheless, falling prices, which is a problem for companies, it means their margins are going to compress. So the all at once has to do with deflationary signals. Now, this week we got the PMI, Purchasing Managers Index, and today the employment report. Both of those are recessionary. So this idea of we're in a recession is beginning to gain more traction. And in fact, the SOM rule in the unemployment report, basically the unemployment rate going up by 50 basis points as measured on a 3-month moving average basis relative to its low, that triggered. And so a lot more people are now thinking recession. Now, we're not thinking at all, when we say all at once, anything like 08, 09. In fact, the rolling recession part of this scenario would argue against that. So we're not at all suggesting that, but we are suggesting that this focus now on pricing power is going to be significant. And the reason it's significant is, in the early 80s, when Fed Chairman Volcker was trying to strangle inflation out of the system with double-digit interest rates. Inflation was also at double digits. So if he was going to make a mistake, that was a big buffer to make a mistake. Our inflation rates today are much lower. And so the Fed actually has less room for error. And I do believe that higher for longer and thinking that inflation was the big risk out there has put us somewhat in harm's way. But half of the solution is understanding the problem. And so I think this cathartic moment is good. It's painful, very short term, these corrections are, because there's a lot of confusion. A lot of people have assumed that the world was going to work one way, and all of a sudden it's not. And one of the things you'll hear about increasingly in the news, I think, is the idea that the carry trade, which involves, believe it or not, the yen, is unwinding. So if you look at the carry, what people mean by the carry trade, it means that many investors and speculators borrowed yen. So they were effectively short yen. They borrowed yen because the interest rates in Japan were so low relative to the rest of the world. So they borrowed there and then redeployed those assets, put them into dollar-based assets or other currencies, but primarily dollar, often into our treasury bonds, which were yielding more. Now, since 2011, the yen has either been depreciating or stable. And so it was kind of safe if you were making the bet to short the yen or borrow the yen, that you weren't taking that much risk. And in fact, if the yen went down, you got the benefit of that, plus you were earning higher rates in the U.S. Some people think that part of the carry trade was by borrowing yen and then buying the Mag 6 or one of the broad-based benchmarks in the U.S., the S&P 500, the NASDAQ 100, both of which are very heavily populated and weighted with the Mag 6. So again, that we don't know how much of this went on. There are some guesses. A Deutsche Bank study suggested it could be $20 trillion. Now, think about that. Our GDP is roughly $25 trillion. So can you imagine this carry trade, which was becoming a consensus trade, to the tune of $20 trillion? I don't know if that's true or not. The other way to put it in perspective is I believe the global equity markets today are priced at roughly $130 trillion. So $20 trillion in the context of $130 trillion is also a very large trade in the market. So we don't know the exact number. It does make sense watching how violently the yen is actually appreciating now that this carry trade is unwinding. So people who had bet on the yen continuing to depreciate are changing their spots. They're cutting their losses, or they're getting margin calls and are having to sell. They're forced sellers. So that's now the other thing that could be going on, just trying to understand what else could be going wrong out there. We've tried to figure out, okay, where is the biggest leverage out there? And that carry trade certainly was leverage. So that's, yes, one source of leverage. Another is private equity. And this is where commercial real estate, and especially multifamily in the United States, could be instructive. So we know that for approximately the same amount of time that carry trade has been building, again, since really the 08-09 crisis, so we mark it maybe at 2011, 2010. In the private equity, private credit world, there was a reach for yield in a very low interest rate environment. And so a very big trade, we believe, has been private equity and credit moving into the multifamily space. Rents were good yields, leveraging them up. And so that's another source of debt that we're watching. Now, private equity, private credit very often package this debt up. And many people say, oh, my goodness, could this be a replay of 08-09? We do not think so. What happened back then was subprime mortgages were packaged into AAA instruments. That should have never happened, but the rationale was home prices across the country had never gone down. Pockets would go down, but nationally never gone down. Of course, that changed in 08-09. I don't think we're in a repeat of anything like that. It's more commercial real estate specific. And if we use a marker like in 1986, when I guess the tax laws changed and took away the tax shelter status of real estate, it hit commercial real estate very hard. But the rest of the economy was spared. So just want to, when I say slowly and then all at once, there are some trades that are going to unwind here, but we don't think that anything systemic will take place. What we do think, though, is this idea of deflation, prices coming down. That is something unusual, something we haven't experienced for a long period of time in terms of the aggregate price level. And, you know, 1 month does not a trend make, but the CPI did drop 0.1%, while the PPI was up 0.2%. That represents a margin squeeze for consumer-oriented companies. And we do think falling prices, especially because they're not expected, are going to hit margins. And this is where we come in, and I'll get back into this toward the end of this in the know. But innovation solves problems, and we think that artificial intelligence is going to solve a lot of margin problems. It's going to enable increasing productivity, significant increases in productivity. That might mean in the short term more unemployment, but we don't think it's going to get out of control. So I'll get more into that at the end. For now, I'll just go into the usual drill. So fiscal policy, and just to segue actually from the Bitcoin spot we just did, if you look at what Senator Lummis is proposing, and it's not just Senator Lummis, there are others as well involved, they are proposing that if the U.S. does stockpile Bitcoin, that the only reason it can be sold is to pay down the debt. So that's very interesting because, and we may have mentioned it, but the price of gold on the U.S.'s balance sheet is, I think, on average $42 as we've looked at it. And of course, that's what it's carried at. Gold itself is $2,400 today. So that's worth a lot more than we've marked it, or the government has marked it. Same with land. The U.S. owns 23% of all the land out there at cost. Hasn't been marked up, and you know it's worth a lot more than it once was. So that's kind of illuminating in the context of the fears out there that that we're never going to get out of this debt. Now, we agree that spending has been profligate. It's, it went way too far, and that discipline is absolutely necessary. And I think that's part of what this election cycle will be about. But this notion that we're never going to get out of it, we actually have assets that are worth a lot more than they're marked. So that should allay some fears out there. As far as the rest of fiscal policy, though, we are in election campaign season, and that's basically what's going on. Not much else will go on in Washington, we think. Monetary policy, the other thing that came out of the Bitcoin discussions we had in Nashville is, yes, Bitcoin could be a private money, taking us back to pre-Fed days, so pre-1913. Private money competing against, in today, public money, the dollar or other fiat currencies. And because of the rules-based monetary system that Bitcoin is, that could be very healthy competition. Basically, if investors or don't like what the Fed is doing or the government is doing generally, they can increase their hedge in the form of a private money. Now, in terms of monetary policy today, what do we see? Well, we got the June update for M1. It's now up 1% on a year-over-year basis. So no longer declining. We went through almost 2 years, I think, of declining money on a year-over-year basis, certainly 1.5. So in the second quarter, let's just say money growth on a year-over-year basis was in the 0 to 1% range. GDP was close to, on a nominal GDP, on a year-over-year basis, close to 6%. Velocity is therefore around 5 to 6%. The velocity of money is the rate at which it turns over. If we're right, and this cathartic moment, slowly and then all at once, causes consumers and businesses to hold off and say, okay, let me see what's going to happen here. Let me see if interest rates are going to fall. Or maybe the better way to say that, the probability that interest rates are going to fall has increased significantly here. And so if you know interest rates are going to fall, and now there's conjecture it could be 50 basis points in September, and then another 25 to 50 basis points in November or December, maybe both. If you're thinking that way and you're being educated by the media that that's possible, what are you going to do? You're going to wait for the lowest possible rate. Same thing with prices, and this is the deflation. This is where it gets a little concerning. If you believe prices are going to continue falling, you'll wait. And that lowers the velocity of money. So here we are. This is what really does cause a recession, when the velocity of money seizes up. Everybody says, wait, let me wait and see what's going to happen here. The history of falling rates is they are followed by a recession. The Fed is reacting. And very often, the NBER, the National Bureau of Economic Research, which a year or two later backdates a recession, that interest rate cut has usually taken place when all is said and done in the middle of a recession. So we could be a good way through it when the history books are written. At this point in time, be pretty much through it. So the yield curve is still inverted, and here I'm going to go into the charts because I think they're instructive. So I'll start with the 10-year Treasury yield and back up a little bit in terms of what the Fed's thinking. So here you can see 40 years of declining interest rates, pretty much my career, declining interest rates, not straight down, nothing ever is. And then you see a break in the trend around COVID and the supply side shocks and the bottlenecks in the system. And the bond yield got to 5% in October of 23. And many people have been thinking it's just going to stay here. Because inflation's a problem, Fed saying higher for longer. And we've been disagreeing with that. And so we're already seeing the rates come down. We haven't updated since I wrote the report that this chart was in. But the 10-year Treasury as of today is at 3.8%. It's gone down 50 basis points in just the last month. That's a very big move for the markets. And we would not be surprised to see it drop back into what now looks like is becoming more of a base. It would be, let's say, around 2 to 3%. Since 2010, you could, Xing COVID, both during and its aftermath, you can see maybe we're in this 2 to 3% interest rate range. That sounds logical, unless deflation gets out of hand. Then rates will go a lot lower. We don't think deflation will get out of hand because what we're seeing, and as I mentioned before, Amazon, Walmart, Target, Costco, companies are basically saying when they cut prices, the consumer responds. If the consumer did not respond, that would be a problem. That would be a liquidity trap. So we're going to assume we're not in a depression. I don't think we are. And that maybe the normalized level for interest rates is more in the 2 to 3% range until we see how much innovation starts accelerating the growth rate of the economy. So that's the first chart. Now, here is in the second chart where we were trying to illustrate the concerns we had with this chart. You can see the purple line here is the ratio of the metals prices, it's a metals price index, to the gold price. And you can see that ratio, and in fact, I think it's broken below 1 if we were to update this today, That ratio is close to where it was during 08-09, not far from where we bottomed during COVID. So it's telegraphing very weak activity out there. You can also see that the green line is the 10-year Treasury yield, and it, since the 08-09 crisis, has been highly correlated positively with this ratio of the metals to gold prices. Until the Fed started tightening, and that broke apart. This index started saying, watch out, watch out. You might be playing with fire, Fed. But the bond yield was following the Fed. And so it continued to move up. And we do believe now on this chart, you can see if we were to mark it, 3.8% would be where we are now on this chart. So the way the gap is starting to narrow is interest rates coming down, not the metals to gold price ratio going up. And if you were to look at this chart and say, okay, where's equilibrium? Well, if the correlation were to be as tight as it was pre-Fed tightening, we'd be down near 1% on the 10-year Treasury yield. We believe, again, the truth is somewhere in between, and that when the Fed starts lowering interest rates, and we think it'll be fairly aggressively and fairly soon. A little surprised they didn't do it in July after former New York Fed President Bill Dudley said, okay, I've changed my mind. The Fed should cut interest rates in July. He's a very conservative guy, and he's had a very good track record. But they didn't do it. That they are waiting until September. But there's nothing to say that they couldn't go intra-meeting now. And if we do get more cathartic moments in the equity market, the bond market, the commodities markets, and so forth, the Fed might act between cycles, which would be sending a strong signal, and appropriately so. So then on the next chart, here's the commodity price index, just to see where's the greater risk. Many people have been saying inflation, but this chart has been saying, no, the trend in commodity prices has been down since the 08-09 crisis. Remember, oil prices peaked there at $147. And now we're at, mid-70s, so almost cut in half. So the trend has been down, and if I were to update this chart for today, we're at 94. So 94 on this index, below 100 there that you see. And you can see, once again, as we've been emphasizing for quite some time, that's where commodity prices were in the early 2000s. That's before China entered the World Trade Organization and really drove a supply shock, or a demand shock, I should say, increase in commodity prices. And it's also where we were in the early 80s. And so this is not a chart saying we're in inflation. That downtrend line that we've drawn there would suggest that the risk is more on the side of deflation. And then finally, on these charts involving interest rates, the yield curve, commodity prices, you can see here the yield curve is inverted. Today, the inversion is only 10 basis points because short rates and long rates are rallying together. And you can see that here, too, we've been struck that this yield curve has been flattening and then inverting since the 08-09 crisis. And in 2020, when the the Fed was easing aggressively, all monetary authorities were easing aggressively. We never got the steepening back into that 200 to 300 basis point range, or the 2 to 3% range, despite the fact that they were had accelerators to the floor around the world when it came to monetary policy. So the fact that it never got up there told us that there was more of a deflationary undertow in out there that the bond markets were picking up on, but the narrative, the economic narrative out there, was not picking up on. And so here we are, still negative, longest period of negative inversion. Longest period of inversion since the late 70s, early 80s, when Chairman Volcker was trying to, starve the economy of money to basically eliminate inflation. And as I mentioned before, we had a lot of degrees of freedom back here, or the Fed had a lot of degrees of freedom to make a mistake. Because of double-digit inflation. There was a long way to go before deflation. There's not a long way to go now, and that's why I keep coming back to that point. Okay, now we'll go into the next part of the usual economic indicators. I won't spend too much time on this. I think it's clear now we are pretty much in a recession. Non-farm payroll, disappointing across the board. Household non-farm payroll, especially when adjusted for downward revisions, which were significant. If you adjusted for them, employment increased only 85,000. And when you look through one of the adjustments that the Bureau of Labor Statistics makes, it accounts for something called the birth-death ratio, and that's not of people, it's of businesses. So they are assuming that new businesses created more than 90,000 jobs, when the small business sector has been hardest hit by banks' unwillingness to lend. And so we don't think that number is real, and probably employment is even weaker than that 85,000, may even be negative. Average hourly earnings, 0.2, that was a downside surprise. On a year-over-year basis, wages are up 3.6% now. Productivity by many measures is up 2.5%. So that would say 3.6% minus, this is all very back of the envelope, 3.6% minus 2.5% productivity growth gives you underlying inflation, which would be closer to 1, below the 2% that the Fed is aiming for. The work week went down. Now, that's probably weather-related. Hurricane Beryl came through. But nonetheless, that's a drag on the economy as well. I think with this report, we can conclude that the era of labor hoarding after COVID is over. Businesses had so much trouble finding labor that they have delayed laying people off. Now we're at 4.3% unemployment rate. That jumped from 4.1. Expectations were that it would not jump at all. So that was a bit of a surprise and triggered the SOM rule, as I mentioned before. As far as market indicators, where we're going next, I'm going to go to one slide. I know we've featured this before on the last In the Know. This is the concentration slide that has been a big factor in driving the market forward. It was the Mag 6 dominating the broad-based benchmarks. They were the most cash-rich. companies, and they had AI going for them as well. This earnings season is suggesting that perhaps all of the money being invested aggressively into AI might be a little too much too soon. We don't know. Meta Platforms doesn't think so. It's going to, its next large language model, open source, which we think is a big deal, is going to use 10 times the number of GPUs that Llama 3 did. So it's continuing to invest aggressively. But we're not seeing the accelerated revenue anywhere, actually. We are seeing some cloud revenue acceleration at Amazon, which reported last night, but then we're seeing much lower than expected retail, and so you're having an overall deceleration in the growth rate of Amazon's revenues. Low double digit could dip into high single digit according to Amazon's guidance. So, both Goldman and Sequoia, and certainly we've been out there saying, wait a minute, if these valuations and stock moves are to be justified, then other companies are going to have to see profound results from AI. We're not seeing them from revenues on the revenue side yet, but because of this dynamic of prices falling, I think AI is going to become extremely important to accelerating productivity growth. And if productivity's starting point is 2.5% and we accelerate from here, that is going to be a huge bull market. I think people are going to be astonished at how this market will turn around, and it will favor innovation, which is going to get us out of this dynamic. So in terms of other market indicators, the S&P, I mentioned all of the markets are seeing indigestion. We think this rotation, when the markets shake out, is this rotation that has been so Mag 6 oriented, is going to work out not so much from Mag 6 crashing. We don't think that's going to happen. We actually think that they'll underperform. They've done a lot of work in the last few years, especially because cash-rich companies were so richly rewarded. But they might just mark time as other parts of the market catch up. We saw a bit of that in July. Very nice move in small caps relative. We had very good moves generally. And now, of course, and this is a throwback to the early days of the COVID. In the early days of COVID, which, by the way, is when we started this In the Know. We called it back then Stay at Home with Cathie Wood, renamed it In the Know, because at the time, our stocks were being tortured. The market was getting hit. This was the 1 month period when everybody was saying, oh no, the economy is going to shut down. We're going into a depression. And we took a very strong position to the contrary. And during that period, the markets were down 25 to 30%. Our flagship was down 46%. And at the time I was saying, wait a minute, who do you think is going to solve these problems? And of course, the problem then was COVID. Who was going to sequence that virus, use synthetic biology to create tests for the virus? Who was going to create the vaccine for the virus? And we were saying, this is innovation solves problems. Our companies are going to help. Who's going to digitalize while we all work at home? So forth. And that was a 1 month period. And then, of course, 2020, the rest of 2020 into 21 was unbelievable. Too much so, as we now know in hindsight. We think that is a microcosm. That 1 month period for actually what we've been in for the most part of the last 3 years when it comes to innovation. And we think now that there's a real reason for this innovation to take off even more so than just addressing COVID and remote work. But this idea, which is even broader, that prices coming down are going to force companies to find ways to increase productivity. And we think there are all kinds of ways with robotics, energy storage, artificial intelligence, blockchain technology, and even interestingly, in the multi-omics space, we're seeing now the cost, thanks to artificial intelligence, the cost to discover new drugs is collapsing, and the time necessary to discover collapsing. We hear this from researchers all over the time, and that is why we have such a heavy exposure to that space, because we think miracles are going to come out of that space, cures for disease. And it's not even when. The first commercialization, the approval has taken place. We've mentioned this many times, CRISPR Therapeutics, for sickle cell disease and beta thalassemia. So the FDA has approved it. Now they're commercializing in the second half of this year. And it doesn't seem like insurance companies are balking at the price tag for one and done in CRISPR gene editing. Insurers are willing to pay $2 million. Maybe not up front. Maybe up front there's a 10% down payment, and then every year the disease does not recur. Again, just one dose and no recurrence. And for one of the patients, we're 4 years almost into the trial, and he has not had a relapse. So the payments will be over time, but net. And the system will save significant healthcare costs, because all of these people are not going to be going to the emergency room and taxing the system in a very expensive way. So we do think that what happened during COVID, both the precursor to the market turning, that drop in the market, and then what happened, that was a foreshadowing for what we think is going to happen during the next 5 to 10 years. And sure, Mag 6 has led the way, and a broadening out of the market, which is what has happened during most of the broadening out that you've seen here. Most times that's in the context of a bull market, where small, mid-cap stocks have way outperformed the mega-cap stocks. The only 2 times on this chart where we've ended in a bear market were 73, where it ended the Nifty 50, and we were about to embark on a journey to double-digit inflation. That is not happening this time, clearly. And then the other time was in 2000, where we ended in a bear market associated with the tech and telecom bust. Many people think the Mag 6 are going to bust. We do not think so. We do think they will underperform as the market broadens out. But we could be in for one heck of a bull market. And you know why? There is so much cash on the sidelines. So much cash on the sidelines that has to be put to work. And we know institutional investors are going to take some of the bond rally they're now enjoying and reallocate to stocks if stocks continue to come down. And we think they will be reallocating to, perhaps it'll be the broad-based benchmarks, but given their outperformance, to some of the underperforming categories. Innovation broadly, broad-based innovation, has underperformed significantly over the last few years. Last year was an exception. We had a big burst, but 21, 22, and thus far 24. And we have miles to make up. And believe me, we know it, and we believe we will. And so with that happy thought, just know that this is a cathartic moment. We think that it will result, I don't know the shakeout, if it's a couple of weeks or however long a cathartic moment in the market's going to take these days. But the resolution, we believe, will be towards a broadening out of the market, favoring smaller cap or earlier stage companies and stocks, and that this should be a very productive environment for investing in the equity market. And just one last thing, just to end on Bitcoin, it is holding like a rock in this $60,000 to $70,000 range. Typically, it's a very volatile asset, and it feels like correlations are going to one, and maybe they will. Maybe it will get hit before all is said and done. But it is behaving like gold, like a risk-off asset. And think about it. How many risk-on and risk-off assets are there? This is truly one of them. And so, as we've said many times, we think we're just at the beginning of the Bitcoin story. So with that, I wish you a happy weekend in the dog days of summer.